Mark Lackey joins us every week. He's Executive VP of CHF Capital Markets. And Mark, we're talking about oil and oil prices. Before we get to that, though, I did see that Goldman Sachs is talking down commodities. You're a bit of a commodity bull these days.
Yeah, absolutely, Pat. And look, there's not just Goldman Sachs. I would say that on the street, the view's split. And you've got some fairly big players who are positive, and you've got some big players who are negative. And, you know, we've seen Goldman kind of flip back and forth over the last few years. And I think that if they do get some weaknesses, then they tend to then change their philosophy and start to go long. So, you know, again, they tend to be more optimistic on supply on a lot of the commodities than I am. So I think that's our biggest difference. The demand numbers aren't really much different, but they seem to think there's going to be more supply out there in a lot of these commodities, and hey, we'll see.
Well, you have to concede there is a lot more oil being found these days, and our discussion is going to be on oil. What do you think?
Well, there is more oil, Pat, but one of the things people should remember is that as somebody who's out of the oil business myself, decline rates are much higher today. So when I was in the business, a lot of fields were 5, 10, 15% decline rates. You got some of these.
What's a decline rate?
Okay,
We should
so in
explain
other
that.
words, Pat, the first year you're producing, say, 1,000 barrels, and then you go down to 990 the next year.
Right.
In the Bakken, for example, where you got 1 million barrels coming out of there right now, some of those decline rates are upwards of 25, 30% in 1 year. So to replace that means it's not quite as simple as it once was. So I would say, again, there is more supply coming in certain areas in the world, but it doesn't stay up as quickly as people might think. In other words, because of these decline rates that are out there.
Are the decline rates higher because of fracking? Like they get it out of the ground faster kind of a thing?
Yeah, and the formations. I think you're right. I think it's both fracking and the different types of formations. Those are two of the big reasons why the decline rates are different than when I was in the business, and most of our oil it wasn't even oil sands in those days or oil shale. It was all pretty much traditional, conventional oil.
So while we're awash with oil right now, inventories are high, we've got all kinds of that stuff. What you're suggesting is 5 years down the road, that might not be the case.
Well, and you know, Pat, one of the things I'd like to point out is that we talked before about how gasoline demand's recovered in the United States. We talked about 20 million cars a year now in China. I think the new election in India is actually a turning point because you've got a government now that really wants to improve infrastructure. 300 million people have no power in India. I wasn't aware of that till the other day. And they're trying to build more roads and really aid the auto sector because the production in India is about 1.5 million a year. And 16 here in North America and 20 in China. So you can see how much catch-up they have in India. But they've cut taxes now on autos with the new government. And I just saw June was up 15% year over year. So a big move in auto sales. Now, I'm not saying because they had one big month this is going to be sustained at those levels. But I think there's a lot of potential given the demographics and the age that gasoline demand and oil demand in India could actually rise a lot more quickly than I think most of the consensus people are looking at.
So flash might flare out while demand is accelerating.
Absolutely.
Okay, so what's your forecast for oil then?
Well, you know, Pat, I've got a range. I've said it and I haven't changed it. I'm kind of 95 on the low side, about 115 on the upside over the next 3 years. People say, why do you have a range? Well, there's still a certain amount of seasonality, as we all know. It's not as important as it once was. But you will get times where demand is somewhat weaker because it's, you know, you're between the driving season and the heating season. Typically, you're going to get some weakness in the price. There's always these political events that come on. We saw the situation in Iraq, then it seemed to back off. Prices went from 106 down to 100. They're now back up in the 104 range. But things like that can flare up anytime. I mean, you know, that could be a problem tomorrow. Who knows? So we do have this range, but we're really positive, Pat. And I would point out a number of people are looking at 80 or 85. They look at the futures contracts. I will tell you right now, that's not a very good way of forecasting the future. You should do it on some kind of supply-demand basis, not what a point in time some people are selling oil for out 2 years.
Yeah, because the December 2015 oil futures is at like 85.
That's
where
right.
that number
And,
comes from.
you know, I look at that and I'm aware of it, Pat, but that's about all I'll say is that, you know, if you're going to use those, because I'll go back 4 years ago, 2 years out, 4 years ago, people were looking at 120. We did not trade anywhere close to 120.
Yeah.
So I think it's useful to look at those, but do your own supply-demand analysis. That's the best way to have an idea of where you think the prices are going.
Oh, okay. Just a month ago it was 107, or
That's right.
Or
Last time
more.
I was in here was 106.90.
Yeah. So can it pop higher, significantly higher?
Well, look, Pat, if you know, it's all the potential problems out there. If Libya flared up again, if the ISIS guys got more success in Iraq, who knows what's going to happen in the Gaza? There's all kinds of things in the Middle East and those areas that could cause prices to go up on that basis. As far as fundamentals, do I see a reason why it would pop up quickly? Not necessarily. But these political conflicts could certainly, I could see 125, 130 in a bad situation.
Well, okay. So here's your ideas. Emerald Bay Energy.
Right. You know, as I've said recently on the show, Pat, I'm really becoming, I've always been a stock picker, but my filter's getting tougher. I want people to reach certain milestones. This is a West Texas play, Pat, and you've got West Texas management, big acreage, 6 projects. They just found some more oil with the recent drill results. So I think this is a company now that people should have on their radar screens because they've turned the corner. I would call this low to medium risk based on my days in the oil business, given where they're drilling. Because now with the fracking and the horizontal wells, this oil wouldn't have been found, or well, we knew about it when I was in the business, but we couldn't get it out. Right. So this is really something that's only been available to people in the last year or two. So I think they're in the sweet spot. This is this whole Eagle Ford area in Texas is going to be, I think, the next big boom area because of the technology now that exists.
Okay. Emerald Bay. So the next one is Brichem Corporation?
Right. One last point on Emerald Bay, I should point out, they are selling gas into the Alberta market starting August 1st. So they get cash flow. That comes from electricity generation. I should point that out because it's additional cash flow in their Alberta operations.
Brichem.
Well, we've had this on before, Pat, and I thought the recent announcement was a major turning point for the company. They were, as you know, in the liquids business and also steel pipe. Yep. They sold the steel pipe. It was a good business, but the liquids business, Pat, because those liquids are used in the very formations I was just talking about with the previous company, that's a huge business. And what Brichem did in the last few years was they decided to start buying out these liquid companies, smaller companies, in anticipation that the liquids business would take off. Well, they were in fact correct. The one thing the market was holding back, though, was saying, well, your steel pipe's okay, but it's not hugely profitable. So they sell the steel pipe, and now we've seen the stock move up here, I think, from $1.50 to about $1.80 just in the last week and a half since they made the announcement. But I would say, look, if you're worried that this moved 30 cents, I wouldn't. I still think there's a great opportunity here because these guys are well positioned, particularly in Texas. And as I just said, that's the area of growth.
Oh, okay. Brichem. And then Traverse Energy Limited. Yeah,
now Traverse is, now I'm back in Canada, Alberta principally, and now this is largely an oil play with some wet natural gas, which of course is more positive given the condensate. This management team had a company before, Raven Energy. We did extremely well on that, got taken over. They've come back now, they're building up the production, and what I noticed was they've got a huge land position. So they've got a lot of potential to drill and come up with a lot more production in the next year or so, which then, again, will make them attractive to mid-cap or bigger companies. So I see this as a takeout, but probably not in the next year or so until they get to a production level that will attract takeover talk.
A little bit more speculative on your part then.
A little bit, but they do have production already and cash flow, so I would say that compared to companies that are out there right now in Alberta that have no cash flow and no production, those are really the speculative guys in my view.
Whatever. Mark, great to have you back.
It's always good to be here, Pat.
Mark Lackey joining us.